All right, we are about 15 seconds away from getting this thing started. 10 seconds, and honestly, we might as well just get it started. Let's close out of this right here. I think the notification's going to come up in just a second. And let's get started. Camera one, welcome back to another weekly live stream stock market scan, research session, recap, whatever you want to call it. One of these days, we said every week we're going to come up with a better name. It's been a really, really nice run so far in 2023. Last week was an awesome week from an outperformance perspective. We kind of were in line with the market, but the good news is that the market went up, so we made more money and we continued the run of profit that we've made so far in 23, and we just keep building one after another, and it's starting to turn into a really, really nice year as we've completed the second month of the year. So a little bit behind us, a lot to go. Let's talk about what we've done. Let's talk about what we're going to be doing. And I don't think there's any more reason for me to be taking up the entire screen. So let's switch back here, put me back in the bottom corner where I rightfully belong, and let's talk about the last week in the market. So recapping right here, we made $2,702. Commission numbers, I think a little small. It's probably more in the 70 to 80-ish area. I need to recalculate that. Admittedly, I haven't updated the whole spreadsheet yet, so falling behind a little bit there. But regardless, it was a really, really nice profit number, just south of 3,000 bucks on the week. And more significantly, we really didn't have any losing trades. It was one of those perfect weeks, quote unquote, that we like to talk about. Top to bottom, you really don't see any red. The only place you see red is Fubo, which are two strike calls, which we lost a little bit on that because we made money on the shares for an overall gain. And then we lost $10 on UVXY, which was our hedge. So if we only lose 10 bucks on our hedge and make almost 3,000 bucks on the rest of it, that's a pretty good result for the week. But all in all, these things work together to make us a really, really nice amount of money. Nothing too significant to talk about. The only thing that I think is worth noting is the fact that the market wasn't necessarily this high the entire time. If we go pop over to the Thinkorswim module really quickly, type in SPY, go to the 5-day chart here. What we'll see is that on Thursday and Friday, the market ripped upwards because Monday, Tuesday, and Wednesday, it started to fall down a little bit. And despite the fact that it fell, I think the most important thing that we can emphasize here with our performance last week is we were really going to make in excess of $2,000 regardless of what happened on Thursday and Friday because of one, smart positions that we took out of the money with decent cushions on decent stocks, and two, the profit taking that we had during the week, which we executed very, very well. So at the end of the week on Thursday and Friday, it's always great when the market goes up because we've got long-term holdings and things that benefit from that as well. But at the same time, it is a little bit frustrating because we were going to crush it no matter what. And it looks so much better if you make 1.5% when the market absolutely tanks during the week. But look, at a point like this, we focus on running our own race and we're never going to get upset with profit. Getting upset with profit is the quickest way to lose it. And with that said, we're at a 7.03% return year to date. That's a little bit over $12,000 of profit in the first 2 months of the year. If we go to our year-to-date summary, we'll see that yes, the S&P 500 and NASDAQ both jumped up. They're off to a red hot start to the year. I mean, the talk around this really isn't too much different than what we've previously talked about in prior weeks. These things are running way, way hot relative to what they normally do. We're not going to chase. We're not going to chase. We're going to continue to try to build profitable week on profitable week. And we've really only had 2 losing weeks. And the fact that the average magnitude of those losing weeks is an average of what? 316 bucks. That is very, very good progress in the context of our strategy. It's proved itself to be flexible and generate consistent profits so far on the year. Really not too much else to say about that. If it comes back down, we are going to be ready for that, right? The next dip in the market is always around the corner, and the last thing that we want to do is get crushed by that dip. So if we go back really quickly, I don't think there's anything too significant to talk about. Maybe ASTS, right? We opened a 5.56 strike put credit spread, which is a bullish position. Hitting max profit if ASTS finishes the week above 6. What we'll notice about this is we actually closed it out for 10 cents, and we did that, I believe, on either Monday or Tuesday. I think it was very, very early in the week. Either way, we took $100 of profit, and we left $100 of profit on the table. Why is that? Because we were able to realize about half of our profit on a little bit more volatile of a stock, and we were able to do it very, very early in the week. And the reason we do take profits on things like this is because look what happened. Even though on Tuesday afternoon, ASTS was pushing almost $7 a share, within like 36 hours, this thing was down to 5.5 and would have been looking at a loss. Now, by the end of the week, it ran back up to 6, as we can see right here, and it would have hit max profit, but things can always get worse, right? And it's that worst that we always want to be prepared for. And I feel like I say this thing every week. I sound like a broken record. One of these weeks soon, the market is going to crash, and we are going to be thankful for our position sizing and profit taking. But in the meantime, I'm happy to regretfully make $2,700 in 1 week basis. Moving down a little bit further here, really not a ton to talk about. A lot of positions that we wheeled and took assignment on, like Google, where we doubled down. The double down made $82. The initial position hit max profit. That adds up to $404, which is in excess of the initial, where is it, 274 loss. So even though we started playing Google at like 94, 95 a share, and since then it's gone down, I think. Yeah, it's gone back down to 94. It still kept running. But on a 2 week basis, it's basically been flat to slightly red, and we've made $130 on it, which is about as safe as it gets. But a lot of different trades like that. Fubo is a good example of one where we took some profits, and if you look at Fubo, you'll see that that one was a good idea, right? We took profits on this little bit of a bounce right here. We saw that they had a big earnings drop. They bounced back up, took some profits there, and then it fell all the way back down to 170. So that one we would have lost a decent bit more money. But we were able to take $120 of profit. I believe our max profit there was somewhere in the neighborhood of $200-ish. So we took $120 of profit. We left maybe 80 on the table, and it is a good thing that we left that 80 on the table, because this position would have been red. Valdi, shout out for the subscription. Appreciate that. Thanks for tuning in. Let's see. PANW, not a ton to talk about here, right? It was one of those overbought stocks. We like to talk about RSI and dictating whether or not we want a bullish or a bearish entry. We look at PANW. We go to that 1 year chart. We know what we're going to see, right? We go 1 year. Boom, it's in the red, right? Anytime this gets above 70, meaning the relative strength index is above 70, we know that it's probably a little bit of a bearish indicator. And this thing, we played this bullishly at 130. Why did we do that? Because it was in the blue. And more often than not, you're going to see this same trend. It gets in the blue, runs back up, and then once it finds itself in the red, if we could find a little bit of a level of resistance that we could be comfortable with, and in this situation, it was about 195-ish a share. Typically, that's a decent place to play it back down, because when you look where it started to stall out. 195 a share. Looking back left on the chart is a very, very helpful exercise. Using RSI as well to guide your decisions is also a very helpful exercise. And doing both of those things, we were able to sell a 195-205 strike call credit spread. Over the past few weeks, we've kind of been selling some of these naked, but I'm leaning towards the preference of just buying a very, very cheap further out of the money. You don't need to go with the 195, 196 super tight spread where, the option you're buying on the back leg of the spread is almost as much as the option you're selling, but maybe take it a little bit wider so it's less to hedge, and it reduces buying power and reduces risk, quite frankly, on a naked position. If we scroll down, you're going to see a little bit of that with WIN, MCK. We did it with OKTA, PANW again. But that's the general strategy. Then we'll talk about that in just a minute. But again, we were in, we were out. We opened this trade and closed it on the same day, $100 of profit. And all we had to do was take one look at the chart, enter, exit, maybe 30 seconds total of trading right there. And then Snow, similar idea here, and this is something when volatility starts to dry up in the market a little bit, which is kind of what we're seeing as the VIX falls a little bit lower. One area where you're going to find that volatility, because just because there isn't volatility in the broader market doesn't mean that there aren't pockets of volatility that we could take advantage of in certain spaces. And of course, one of those spaces is earnings. And maybe not so much before earnings unless you have some super strong conviction about a stock, but maybe more so after earnings, right? So if you see a big move on something like Snow, this is a great example. It's a big pattern that we've seen play out time after time after time. You could even look back to November of last year in 2022. This icon right here means they reported earnings. They dipped on earnings and very quickly spiked back up. So we saw a very similar trend this past week. They dipped on earnings. They went from 155 down to like 130-ish. And when we go to the 1 year, what do we see, right? It doesn't quite get down to 30, but it was getting close. But the one thing that we did take a little bit of comfort in was that there are some levels of support around here, notably at like the 132-ish level, maybe secondary level at 125. But regardless, what we did was we said, hey, let's take advantage of this implied volatility. And you can see the blue line representing implied volatility. It kind of drops off a cliff after they report earnings. But what's great about this is that when there's a big drop like what we saw, it doesn't all go away right off the bat, right? Right when the market opens here, it's sitting at about 0.59, and then over the next 2 days, that volatility dies out entirely. So yes, there's going to be a much bigger gap upon the announcement of earnings in the morning after. But remember, right after the bell, there's still going to be a little bit of implied volatility that you could take advantage of and sell. And that's exactly what we did, right? We sold that 128 strike put, sold it for $1.26, got out for 26 cents. Another trade that we got in and got out within one trading day for $100 a profit. So boom, just two quick moves like that. That's $200. The way our strategy works, we're not going to have one big trade that carries and makes or breaks our week. We want a bunch of small base hits. We're going to load the bases. We're going to move the runners, so to speak, right? Spring training's coming back. Some baseball analogies in the stock market. But we're going to load the bases. We're going station to station, 100, $200 at a time, and let the quantity of your trades do the work for you. And that's what we did right there with Snow. And you'll see this thing ran way back up to 142. We didn't even need to worry about it. But again, taking profits early is the way to do it. So all of that added up to $2,757 of profit before commissions. So great. We're up past 12K on the year. Our year-to-date return is 7.03%. That's fantastic, right? We know that compounding returns in the market are a great way to evaluate your performance and how sustainable it will be, what it'll look like. Because a lot of the time you'll have people with option trading backgrounds say, hey, I am used to making like 50% on a trade, but those are the same people who are very used to losing a lot of money on a trade as well. And what you'll see from our year-to-date summary is that we haven't lost more than like $300 in a week. So less than like 0.2% return has kind of been our worst week so far in 2023, a year which has seen a decent bit of volatility. But the point being 7.03% return in 2 months. If we started with January 1st, we run it to March 1st. That's 2 months. Our return so far is 7.03%. What does that annualize to? That annualizes to a 52.24% return in the market. So if we can keep that up and get to a 52% return in 1 year in the market, that's phenomenal. So for those who are following along and maybe getting a little impatient because you're like, it's been 2 months, 7%, we're trailing the market. Rest assured, major point here is that we're making these not necessarily because the market is ripping upwards, right? Because we were on track to make a couple $1,000 before the market ripped upwards. So we were going to have a pretty solid week no matter what. But we're kind of running our own race, aiming for 1% a week. And, 7.03% realized profit so far gets us to 52 on the year. So that's a great place that we could potentially target to be. And again, realistically, all we want to do is just outperform the S&P 500 and NASDAQ on a 1 year basis. So I don't really like to set percent return type goals, but things definitely have been going very well so far. But not a ton to talk about. Everything went so well. Normally our weekly recaps revolve around the losing trades, but there really weren't any losing trades to talk about. So great news for the stream tonight is we've got a good 45 minutes that we can just dedicate to research and talking about our game plan for the upcoming week. Because of course, if you're watching this right now, yeah, it's great and good and well that we made money last week, but you're probably like, all right, HT, like, how the hell are we going to make money this week? So let's get into it and talk about our plan for the upcoming week. And I'll zoom in a little bit on that and take a sip of water. And one other point, these HT tumblers right here, that's right, the branded merch. If we get up to 30 live viewers on a stream, we'll be giving one of these away for free. So tune in, tell your friends. I probably should do a much better job on my end of advertising these things, but hey, that'll come. But again, once we hit 30 live viewers between YouTube and Twitch, these are going to be in the mail for somebody, a lucky viewer. But more important than a tumbler, let's try to make $3,000 in a week again. And the first thing I want to talk about is maybe a little bit contradictory to what I just said, is we're not going to try to make $3,000 in a week again. What's our goal? Our goal is a 1% return per week, which is roughly, $1,600, $1,700, $1,800-ish a week. So what we have set up right now is a very, very low risk portfolio. Why is that? The answer is because we always want to be a little bit cautious of the market when it starts to run back up like this. Over the past month, it had dropped from 416 to 391. That's roughly a 25-ish point drop in the market. That's decently significant over that time frame. However, again, let's talk about that time frame. This is from February 3rd to March 2nd. It's basically an entire month. Yet we've almost recovered, we've recovered almost 2/3 of that in 2 days. That's something that doesn't necessarily sit well with me. And something from a technical analysis perspective that our good buddy RSI would probably have something to say about. We've run up a little too much, a little too quickly, in my opinion. So we want to take our foot off the gas. And if the market keeps running, the market will keep running, and we'll have some positions going that'll make us some cash. That's the idea right here. But if it falls back down, what we really, really want to do is be careful and protect ourselves so that the next time we see a big slide like this, a really steep slide in the market, a big 2-day red candle fest or something crazy happens, we don't want to lose all this cash that we've been stacking up. So kind of start from square A, take things on a week-to-week basis. If you have to roll something into the next week, we do it. But we're basically starting with the fresh slate after profiting on everything from last week. So with that said, let's talk a little bit about what we've got going on. And again, we're looking at the 180-day chart here, and RSI is at 68.24. The 1-year chart is really what we like to lean on more than anything else, and that's at 52.82. So relatively middle of the road from an RSI perspective. So with that said, our very first trade is a very middle of the road trade. It's an Intel. All these are expiries are March 10th. We like to sell the shortest expiry possible for a lot of these stocks. That's going to be next Friday. So we have an Intel 26 put, 27 call, strangle. And what does that mean? We sold a 26 strike put. We sold a 27 strike call. We got a 53-cent credit. So if we pull up the Intel chart, let's go remove all of the other drawings. Maybe take a look at this on a 10-ish day basis. Remove old drawings. See you later. Let's start this thing fresh. So what we know is that our max profit on this trade is going to be between $26 and $27 a share. So our max profit range is boom, 26, boom, 27. And you might say, HT, that's kind of a tight range for max profit, and you'd kind of be right relative to the movement of Intel. But the great thing about Intel is I think it's reasonably valued where it sits. So if it runs any higher, I'd be happy to play it back down. If it runs any lower, I'd be happy to take assignment and play it back up. But the good thing is, it's not moving like some of these other crazy meme type growth stocks that we've seen in 2022 and 2023. So I'm happy playing it within a range. And the great part about these strangles is we know that, yes, this is max profit range. It might be a little bit more helpful to view this on a 5-day basis. Yes, this is the max profit range, but since we received a 53-cent credit, our profit range itself is 53 cents above 27 and 53 cents below 26. So effectively 27.5 all the way up here and 25.5 on the low end right here. So we extend those to the left. We zoom out a little bit. Why? I guess my first one didn't register. But basically max profit between these two lines, and we have a much wider profit range period. And that's kind of what we're going to lean on. Would it be great if Intel finished between 26 and 27? That'd be fantastic, right? We'd make a quick $265. But if it doesn't, contingency plan is 1. The fact that we've only sold 5 contracts here. We have capacity to sell 10, maybe 15, maybe 20 if things get crazy, but we're starting with 5. If the trade goes well, we make money. We never need to think about it again. But if the trade goes against us, we manage the position as normal. If it breaches on the low side and goes down to 25, what's happening here? We're going to get shares with the basis of 24 or 25.47. Nice mental math there. And then we're going to just wheel those 500 shares, and we're going to sell covered calls to drive the basis towards 25, and then sell some more cash secured puts to take the basis below 25. And all of a sudden you're working with a bearish or bullish trade rather, with a break even down here. So with these strangles on some more stable type stocks that are having some brief volatility spikes, you could set yourself up with a really nice bearish or bullish trade by entering into these strangles like we have. And a great example of what happens if it goes against you literally happened 2 weeks ago to us, right? We started with an Intel strangle. We ended up having to double down with another strangle, and the net effect of that ended up being a $630 loss because we started with the strangle that lost, $675. We added one that made some money. But last week, what happened? We ended up taking all these shares. We sold some covered calls, and all of a sudden, we got our loss back under $100. And while it didn't quite get us back positive, the main thing about this strategy is, as we saw last week, we win a lot. Our win rate is very, very high. The important thing here is limiting the losers. So even if we have something like Intel, where it's the big loser, quote unquote, in a week, and we, within a 2-week basis, can get it back to a double-digit loss, that's a great example of limiting your losses. Then we just keep playing the stock, right? And if we hit max profit here, all of a sudden we're profitable overall on these little Intel strangles. So that's kind of the idea with the strangle. Now that's the only stock-based strangle that we have. We do also have XSP, which is an index-based strangle. So while we're on the topic of strangles, let's talk about that one. And one key thing to note here with the strangles in general is you really need to pick stocks that aren't, you know, that aren't gonna either fly up or completely tank. Reason being is that, the 26, the low end is technically cash secured. We could take shares. The high end is naked in the sense that we don't have shares yet to have those be covered calls. So in theory, there's infinite risk to the upside. However, in practice, you're probably not going to hit anything crazy with a stock like Intel. It's not going to go up 100% in a week. Now, of course, those are famous last words, and I'm sure someone will dig that video clip up if that does happen to us. But that's the general idea, right? Much better a stock like Intel than a stock like, Lucid or something, where you see these massive spikes and 40% drops and yada, 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 and it's just going crazy. This is the type of price action that you do not want to see, which brings us to our other strangle, which is going to be on XSP. This is the S&P 500 index. It does not get less squeezy. Yeah, is that correct? Less squeezy? Exactly. It does not get less risky than just playing the S&P 500 index. So we'll take a look at this on a 5-day basis. We'll remove the last one we had. And, while we're on the topic of these XSP strangles, they've been working great. The one that we had set up last week, we took $239 of profit on it. And if we go to the XSP strangle, I think we closed that out for, what was the number? We got to update that really quickly. Closed it out for $1.09. So if you take a look at XSP, the little tab we've got going, 109 all of a sudden, that's a $239 profit. So since we've started doing these mid-December, we're about a week away from hitting the 3-month mark on these. We've taken home a profit of $1,764, and that's a 22% profit if we want to play the annualization game again, right? From December, when do we start these things? December 16th to March 5th. December 16th to March 5th. We've had a return of 22.05%. That annualizes to 151.09% the way that we've been running these, which is a fantastic result. Now, they're a little bit riskier because you could probably lose a little bit more, and we haven't really had a massive spike or massive dip in a week that would have caused us to lose more, and it probably is coming at some point, but stick to the script. Stick to the plan. These are going to be relatively loss limited because the market isn't going to go up like 40% in a week. That's just not something that's going to happen. So we stick to the script here, and it's been working very, very well. Very rarely do we have individual weeks where we end up losing. We've refined the strategy a little bit. We want to avoid big market news weeks, and we've accomplished that so far. And we've got another one set up the way that this is going to work. We sold a $3.99 put. We sold a $4.10 call. What does that mean? Again, those strikes, just like we looked at with Intel, that's going to be our max profit range. So let's remove these old drawings really quickly again. Let's zoom out a little bit. $3.99. Where is it? Where is it? Where is it? And then the other leg was $4.10. So $4.10. Anything within here is going to be a max profit for us. And that's a pretty wide range on a 5-day basis, right? If you take this with, you can almost fit last week's activity into that, which is a very, very important point to note. And again, the most important point to note with these strangles is that it's not just the legs. It's the legs plus and minus the premium. So while this is our max profit range, our break-even range is 413.30 on the high side, 413.30. And then it's going to be about 396 on the low side. So we're going to go 396 right here. And that's what we're looking at. So really nice max profit range, even nicer profit range. And what we know about these strangles is technically one is a half size position for purposes of what we're doing here. So if that break even gets breached at some point, it starts to move against us, we still have a plan B. And the great part is, look, if it never even gets outside of these outside red lines, we don't need to touch a single button. We took 2 seconds to put this trade down. We let it run its course during the week, and it could be the easiest $330 we've made in our entire life. Or we sit tight, we keep an eye on it, it runs outside of one of these, and then we scale into plan B. But either way, it's really only one trade that's going to be used to manage this. So we hang tight, follow the strategy, and that is what our 2 strangles are doing. So on a cumulative basis, max profit, these things are going to be making $595 for us. Let's get into the bullish trades that we've got for next week, right? So we've got 2 strangles. We've got a few bullish trades and then a few bearish trades to kind of balance things out. Why do we want the balanced portfolio with 2 strangles and then equal bullish and bearish trades? Again, the answer stems back to where the S&P 500 ETF SPY is. Go to the 1-year RSI, and it's at 52.82. Anytime it's around 50, it's a neutral market. We don't want to get in front of it one way or the other and try to guess where it's going to go from here. We set our positions to be somewhat neutral. We let it take care of itself, and then we react to it. We don't want to guess, we react because we have the tools to profit off of moves like that in the market. So we pop over here, we pop over here. Lyft, what's the first bullish trade that we have? It is the Lyft 10 strike put, and you'll notice that we played this one last week. If we could find it, we made 115 bucks. We played Lyft again before that, 75 bucks, so $115 of profit, $75 of profit. And did we play it again the week before that? We did as well for 260 bucks profit. So we've made $450 in the last 3 weeks off of Lyft, just playing it off of this 10 level, which I will show you once this chart pops up here. Boom. So we go to the 20-day. This is the 10 level that we've been playing. Let me remove these drawings once again. Remove drawing, remove drawing. And this 10 level, it's been great to us. And we've seen that it did breach it, but what do we do when it gets breached? We sit tight and we wait, and we let the premium that we've sold kind of handle the position, right? Most important thing to note is that we're starting again with the half-size position. So if it moves against us, we sit back, we double down, and then we let it ride. So we started with the 10 strike put. That's 29 cents of premium. We know that our break-even price on a weekly basis is going to be 10 minus 0.29. That's going to stick us at $9.71 a share. So while this nice red line here is our max profit range, 971, as long as it stays above here, we're making money, period. And again, it's another situation where we don't need to touch a single thing, right? That's the best part about this strategy. It's the fact that you don't need to be glued to your screen 9 hours, 10 hours a day doing research, looking for entries, looking for exits, banging trades out. We don't make a ton of trades, right? We set things up Friday. We let them run the course of the week. And then we manage as the strategy dictates. And of course, on a Monday to Friday basis, on a day-to-day basis in the market, there's so much that goes on. So we absolutely can and will take advantage of opportunities as they present themselves. Remember, we said that we want to react to what the market gives us. So there will be trades that we add during the week, but generally our week is driven by what we have set up going into it, which takes I think 10, 15 minutes on a Friday afternoon to set up. So it's great. Set your trades. Go outside. Go play golf. Go climb a mountain. You don't need to be inside staring at a computer. Set the trades up. Live your life. Come back to hopefully a $3,000 profit at the end of the week like we had last week. But again, that's the idea with Lyft. It puts us in with the half-size position at a decent basis. And again, if it goes below that basis, we double down. That's our plan B, and then we keep working it from there. Next bullish trade is going to be Google, the 93 strike put. Again, we're pretty happy with where Google is sitting from a valuation perspective. Anything under 100, I'm happy to continue to sell cash secured puts on. Why is that? The answer is that, some people will make the argument that fundamentals don't really matter in the market. But when the market starts to turn around and start going down, fundamentals are almost the only thing that matters. And we always want to have that situation in the back of our heads of, okay, what do we do if there's a disaster in the market? What's going to happen? How are we going to protect ourselves? What stocks are we in right now so that if something bad happens, we're going to be able to navigate it and come out successfully on the other side? I think starting positions in Google at this level is a great answer to that. So what we see here is Google has a PE ratio of 20.63. which effectively means it trades at like 20x forward earnings, or historical earnings. If we go to the SPY stock, I don't know if it's going to have PE ratio on here. It doesn't. S&P 500, I'm going to do the Google search live. Average PE ratio. You can see that I've done this search before. I want to go to, let's see, is it this site? It is this site. The current S&P 500 PE ratio is 21.63. So 21.63, right? We look at Google. We see that Google is 20.63. It's actually lower in relation to the valuation of the rest of the market. So what's driving it up, right? When you think of something like Google, you think of Apple, you think of, Netflix, Microsoft, Facebook, etc. If we look at Apple stock, remember Google is 20.63, Apple's 25.66, so it's more overvalued relatively speaking. If we look at Microsoft is 28.38, so that's even higher. We go take a look at something like Meta, and honestly, I don't know what this is going to come out as. I think it's actually a decent PE. It's 23. But, again, PE ratio is one of those things where a month ago when Meta was trading, 6 months ago, 3 months ago, where is it? When Meta was trading under $100 a share, this PE ratio was like 10, which is phenomenal for a company that's making that much money. And what you'll notice is when that PE ratio got super low, what happened over the next few months? It popped up, almost 2x. It is 2x, right? It's doubled from the low. Whereas something like Microsoft over a similar time frame, which already had that higher PE ratio, yes, it did run up, but it was nowhere near doubling in price or something like that. So that's why we like to look at that PE ratio when trying to make a more fundamental play like that on Google. So that's what we have set up for next week. We've got it set up. Let me not tab away from this. We've got it set up at the 93 level. We know that if it finishes above this number right here, we're going to hit max profit. And we sold that for a premium, of $1.04. So if it finishes above 93, if it's green, if it's flat, if it's just a little bit red, we're going to make 104 bucks on it. But if it doesn't, once again, we're going to do what we did before. We double down with the lower strike. We get more premium. Wait for it to come back up, and just rinse and repeat. The rest is history. It's the easiest little trade cycle. And with these more sturdy stocks, more stable stocks like a Google, these better valued stocks, it's much less of a heart attack when you enter into some of these trades. So Google, 93 strike put, boom. That's what it looks like at max profit. And then our break-even price, of course, will be $1 lower than that at 92. So we look at that on a 5-ish day basis. Max profit here, profit here. Anywhere below that, we just manage and keep the line moving. And our second to last bullish trade is going to be Affirm, a 13 strike put. And ever since our big initial loss on Affirm back at the beginning of 2022, we've actually done a very, very good job playing this stock. And a lot of that has to do with the fact that the year kind of came out of the tires pretty quickly on it. But we learned a good lesson about position sizing, which we've imparted upon the rest of our overall portfolio. And we've continued so far this year. So if you go back to last week, what did we do? We sold a 12.5 strike put. We sold it for 48 cents. Boom, max profit, easy 240 bucks. And again, that's a half size position right there, right? So if we remove these old drawings again, yada, yada, yada. Last week, if it stayed above this number, we were going to hit max profit. And again, briefly, it got down to 11.96. So this is a great little talk about what happens when it moves against you, right? It got far below 12.5. It went down to 11.96. Our max profit level was here. But remember, let the premium take care of you and save the trade and let you sit back and just wait. Waiting is the easiest and the hardest thing to do with this strategy. But remember, 12.5 strike, you sell that for 48 cents of premium. What's your break-even price? Your break-even price is 12.02. So our max profit is here, break-even's down here. So even if it goes to 11.96 for a second, just wait a minute. And that's exactly what I propose to do anytime you get a trade, anytime you have a trade that gets breached like that. Because two things can really happen. One, it's a little bit oversold, it'll bounce back. Boom, that happens a very good amount of time. Or two, it's going to get worse, in which case you are going to hate the fact that you doubled down the second your break-even price was breached. Because again, if it's close-ish to your break-even price, even if it's only 10, 20, 30-ish cents near your break-even price, you could always roll that position in the next week. You could always sell additional premium. Things are going to be okay. So let's keep the line moving here. We go down, and for this next week, what do we have? We have a 13 strike put. We have it for 40 cents. That means 13 is going to be our, max profit point. 40 cents below that is going to be our break-even price at 12.60, right? Which is fantastic for us. So boom, look, that's another 200 bucks of profit right there. We are going to be looking good at that price point. And again, if it goes down to 12.60, we take shares at 12.60. We could double down. The premium on this thing, if I bring it back in, is fantastic on a week-to-week basis. I mean, at the money, right? It finished at 13.63. If you go dead at the money, you're effectively looking at 60-ish cents of premium right at the money. So if you sell a put at the money, you sell a call at the money, and kind of average in with the straddle at the money, that's $1.10 a premium. So if we run into a situation where we have to take these shares on at 12.60, we could run that type of a trade for the following week and get our break even down at like 11.50. So then if you look at that on like a 10-day basis, all of a sudden an 11.50 break even price, boom, you're down here. So that's how quickly and how easily you can manage these trades by utilizing stocks that have nice premium. Now, of course, the downside is that it can do something like this where it's always liable to go from 13.5 to below 12 within a 24-ish hour period. But that's just kind of some of the risk we run, and that's okay because we have some cash in our back pocket. We start with the half size position. We double down if we need to. Not much else needs to be said about that. And then the last bullish position that we have is MCK, a 330, 340 put credit spread. You may say, HT, like a put credit spread on this kind of stock. We haven't really played this stock before. We don't play a lot of put credit spreads. What's going on here? So in our scan, MCK came up as an oversold stock, meaning that, boom, on a 1-year basis, RSI is down at 28.14, firmly oversold. So what do we look for now? We look for a point of potential support, and we find that right around here where it bounced off of this level a bunch between mid-September and mid-October. So it's coming back down, and as RSI goes into the blue and kind of intersects with the support, that is a price level that you're very frequently going to see a bounce off of. So what we did was we went down to that 340 level. We said, okay, we're going to sell that 340 strike put, but the issue with the 340 strike put is the fact that it takes like $30,000 of cash to fully secure. I don't want to sink $30,000 of cash into a position, quite honestly. So what we do, we buy that 330 strike put right behind it. It's very, very cheap too. If you actually look at these individual legs, we effectively, sold the 340 for like $1.60-ish, and then bought the 330 for like 30 or 40-ish cents behind it, or like 20-ish cents. We got a 1.4 credit. So the difference between what we sold and what we bought was 1.4. So effectively, you sell the one with a lot of premium on it, and look, it's only a 0.5% of premium. It's not a ton, but we like that level because of what it's given us. However, not a ton of premium, but even less premium as you go further out of the money to buy that hedge, to not make it cost you $30,000 to run the trade, to only put your capital at risk at like 860, and that's if it's max loss. So it would have to go all the way down to 330 for you to hit that, which is all the way down here on a 5-day basis. That's a very big move on what's typically a more stable stock, so I'm happy with that. Let's get into our 3 bearish trades that we have, and that'll kind of cap off the lineup that we have for the coming week, and then maybe we could hit the scanners and see if we could find some more. So the first one, we talked about this a little bit at the top of the stream. PANW. We played this one bearishly at a 195 strike last week, and it made us $100. So we had the opportunity to go back in, potentially make $139 more at the 200 strike, which again is a $5 higher target than what we had last week. So if we take a look at what that looks like on the chart, remember MCK, look, we like to play it bullishly because it's oversold. PANW, I don't know why that just did that. We like to play it bearishly because it is overbought. And again, what level do we like to look at? We look over here, and it's tough to really see much, right? It's still hanging out at this level, this 190-ish level. But if you extend this to the left at 200, you kind of see where it broke through, bounced off of it, went below, and then bounced off again before going lower. I don't think it's like the clearest, most defined level of resistance of all time, but I think it's good enough where, 1, you've got a little bit of evidence right there. 2, the thing's overbought. And 3, you've got a little bit of a psychological barrier sitting at that 200 level, which, every now and then you'll see will result in some selling at that level. So we're protected there. Anything above $201.39, this thing's going to make us some money. And then on to OKTA, where I don't think this is a 210 strike call. Let me look at actually what it is, because I did not update that properly. OKTA is going to be, what do we have? It is an 87.92 call spread. So if we go over here, 87/92, boom, we sold that for $1.26. The credit is correct. But again, what's our break-even price on that going to be? We know max profit on this bearish trade is going to be below 87. Break-even is going to be 87 plus 1.26. So 88.26. And again, why do we like this one? We look at it on a 1-year basis. RSI is now at 70.36. Nothing insane, but it was enough to pop it up on that, and we needed some bearish trades to kind of balance out the portfolio in case the market decided to go back down a little bit. So this kind of fit the bill. If we go look at this on a 5-day basis, we know that our break-even price is, again, 88.26. We look at that. That's decently higher than where it's been. The big candle up was a result of earnings. So, a lot of this upwards momentum likely isn't necessarily going to be sustained. If we look back on like a 20-day basis, this is much more normal type price action, right? This is like a $6 window, or $6 range rather, in a roughly, 1 month window that we're looking at right there. So I'm happy with this strike to play it down from. And again, if it gets breached, that's okay. We could actually turn that into just a short position from 87.26, wherever that is, or 88.26, and then just play it back down from there. A lot of the time, when you see this spike in RSI, it's not so much to say that it's never going to go higher again, but in the short term, which is what we like to trade, we make a lot of our trades on a 1 week basis. Boom, spikes on RSI, falls back down in the short term. And again, it runs back up. But look, spike in RSI after earnings, falls back down in the short term. Runs back up eventually, but gives you enough of a little bit of a breather when it hits that number after earnings for us to slide in there, set a target here, have it fall back down, or at least level out below it and take home some money right there. So win is the last one. Very similar idea here on a 1 year basis. Boom, this thing's at 75.75, one of the more overbought ones that we've looked at so far on the stream, but it really has not showed any signs of stopping. We were formerly selling some naked calls on this, but if we look at the single legs, the premium just isn't incredible anymore. And because of that, when you see that there's not a lot of premium, it's not like, oh no, there's not a ton of premium. To me, I just use that as an opportunity to enter into something like a spread. So yes, I'm still happy with like $1.20-ish of premium at like the 118 level, because that means our break-even price is 119. But further, if there isn't a lot of premium, just take that opportunity to go out of the money and buy the leg behind it, turn it into a spread, limit your risk, because naked calls have unlimited, infinite upside risk in theory, but limit that. And what we have is a defined risk trade now where we could make $103 or potentially lose $397. And we make that $103 anywhere below 118. We look at this thing on a 5-day basis. 118 is up here. Decent cushion, right? And anytime this thing gets into that overbought area on a 1 year basis, look, it happened before. It fell back down. And again, it did go higher eventually, but we get out of the trade by then. Look, it gets a little bit overbought. Slides back down. Overbought. Levels out. And again, we don't need it to like spike back down and take a huge U-turn. I would welcome this candle because it'd be a very easy $100 profit right there. But at the end of the day, all we need is for it to just level out. It makes it a lot more stress-free if it falls back down, and it probably could run back up a little bit. But that's why we give ourselves this little bit of cushion right here. We work with this cushion during the upcoming week. But then we sit back, we wait, see what happens. And again, that's our max profit point. Since we received $1 of credit, our break-even price is even higher at 119 up here. So that's an even larger cushion that we're playing that down from a profit perspective. So that's pretty much what we've got this week. And the great part about this is we've got 1, 2, 3, 4 spreads right there. So the buying power requirement is very, very low. So we're not overly reactive. We're not like super bought into the market right now. But if these things go the way that we want, we're looking at a roughly 1% return. And again, why do we like that? Because a 1% return in a 1 week time frame, if we go to March, we say, hey, if we make 1% from this day to a week forward, that's a 68% return in a year. These annualized returns really drive the idea behind the strategy that we like to deploy in the market. So aim for that 1% per week. Are you going to get 1% per week? Absolutely not. That's not what I'm telling you. But if you set that as a target, it's a realistic 1 week target. And then we try to just have as many successful 1 week increments as we can throughout the year. We've got 52 shots at it, right? And if we're successful with a lot of those, as we have been so far this year, right? As we have been in the past, there's our performance since inception against the S&P 500 and NASDAQ. We're outperforming by a very large amount. If you just keep stringing those weeks together one by one and doing what you need to do, being smart about it, putting yourself in a position where, you're not going to take home $10,000 of profit in a week, but when things go against you, you're also not going to lose thousands of dollars as well. That's the strategy that we're deploying for this upcoming week in the market. It's the strategy that we've deployed this year, and it's left us so far year to date with a 7.03% return, which is trailing NASDAQ, but we're back ahead of the S&P 500 despite both of these larger indices having a great start to the year. We're really only trailing NASDAQ by 3.78% right now, so that really isn't a ton at all. We've demonstrated in the past, and specifically so for this week, that if there's a big dip in the market, what we're holding is going to be able to absorb that. So really from an outperformance perspective, in a weird way, we're kind of rooting for the market to go down, even though it might result in like a more muted profit or a small loss on the week. But again, our overall goal is just outperforming these. At the end of the day, I want to make money. So if it goes up, it goes up. And if we make money with the market, that's great. And if we're in line and the market has a great year and we have a great year, That's fantastic. The idea of the strategy, the idea of some of these positions that we're putting into play is that what if? It's that what if the market has a bad week, a bad month, a bad year. That is what we're protected against. So we try to reap the rewards of the up weeks when they come, yet simultaneously protect ourselves from the down weeks because there's always going to be a dip in the market around the corner. And that's kind of all we got, right? We could maybe pop into the scan a little bit. We've got like 10 more minutes before it's 10 p.m. Let's use the last bit of this time because I don't think we've done this enough on these scans. So very first off the bat, let's get to our normal little scanner here, right? We're going to go to high ROR puts without earnings. This objectively is just going to give us the highest premiums in the market. And we need to set that to options. Give it 2 seconds to let it refresh. Now I click scan and now they're going to come up here. Boom. And kind of predictably so. Oh, SI. This is maybe one to talk about from last week. We kind of knew SI was going to go down. Great way to play it. Put credit spread. Or put debit spread rather, not credit. Debit is a bearish trade. Reason being, you say, HT, well, why not a call credit spread? Why do you want to use a put debit spread? The answer is because sometimes when you have a stock like SI where there's a ton of short interest and the stock has dipped a bunch and you're worried about it potentially shooting back up, what happens a lot of the time when you have a call credit spread is you derive the value from the short call. If it flies back up, that short call is going to be exercised. You're going to have short shares, and then you're going to have the long calls you bought behind it to hedge those. From a P&L perspective, it's going to be the same position. However, the big issue is that when you have short shares on a company that's hard to borrow like SI is, your broker could auto sell those shares because there aren't necessarily any shares available to borrow, which leaves you with only long calls. So if the stock goes back down as you thought it would in the first place, you stand to lose a lot more money than your original max loss. With the put debit spread, assignment is not a risk, it's a feature. If you're assigned on that for whatever reason, boom, you've hit max profit, on to the next one. So that's a point with that. But back to the scan, and probably a deeper point about the scan itself is just because something is at the top of this list does not mean that it is a very good investment. This just objectively is the highest ROR in the market. Now we're gonna have a couple filters that we like to intersect with, and if you want to learn about how to use this intersect with here feature, a very powerful feature on these thinkorswim scans. We have a video of that on our YouTube account as part of our option scanning series. But let's kind of look at some of these just to play devil's advocate, have a little fun. Sometimes you don't necessarily have to take the trade, but sometimes it's fun to go to Vegas and look into the high rollers room, even though you don't have any of your own money on the table. It's actually insane. You could sell a 1.5 strike put for like 10 cents of premium. That's nuts. It's a 10% ROR, and you're effectively just betting that the company stays above $1.50, which is here. Like we've zoomed so far out on this chart that we're into the negatives. But effectively, they are maybe pending bankruptcy, so that's not a risk that I want to take out. But if you're feeling crazy, 10% RR in a week, I'm not going to do it, but this also is not me telling you to do it. One of those that sometimes when you're option selling can get kind of boring and methodical, which again, boring and methodical, not bad. We made $2,700 last week. We're up 7% on the year. We've almost made $13,000 this year. Boring and methodical is good. Our boring weeks are our best weeks. But sometimes when you get a little bored and you want something to do, because sitting back and making profit is fun, but if you want to act like, oh, I'm a big trader, sometimes these are fun to look at too and just kind of toy around with. But I'm not doing it. We go to the next one, GNS. This is kind of an interesting one. I think it's like a healthcare-ish type thing, Genius Group Limited. I don't know what's going on here. Big spike up to 372. These typically we'd want to say, hey, we would want to sell from the base of the spike, which would be 2. And there really isn't a 2. There's a 2.5, which you can get like 15 cents a premium for. That would set you up at 235, which isn't bad. I mean, on a 5-day basis, that's not a bad basis to have. What you want to do on things like these is you want to look at the recent news. It doesn't look like anything too crazy is going on here. They're suing somebody. It's an NFT related stock. Don't really know a ton. Looks like there's some redemption of some coupon. I don't know a lot about what's going on with this, so I'm not confident enough to do something like that. But if this is one where you're like, oh, I'm familiar with Genius Group, maybe the 2.5 strike put is for you. With a trade like this, though, what I would caution you, or maybe potentially recommend to do, Similar to what we've done when positions get a little bit too large, we turn them into spreads to reduce buying power and in turn reduce risk. Maybe just buy that one strike put for a cent or two behind it so that you have a defined risk trade. So if something crazy happens to GNS and it goes back down like below 2.5 and keeps running down, you've got a little something protecting you. But again, back to the scan. Main point, just because something's up here doesn't mean it's a great idea. Wish, that one's kind of run away on the downside. Open Door, we've already played that one. We're already in Affirm. Boyle, we know that that one's kind of a natural gas related ETF stock, so not necessarily the greatest thing that we would want to wheel. Wayfair, I think, is still a little bit too high for my liking. UPST is very similar to Affirm. ChargePoint is maybe getting back into the neighborhood of where I would be comfortable going bullishly on it. Well, remember, I think we've played that one around like the 9 or 10 level historically. ChargePoint, they had earnings that weren't the greatest, but again, we've seen this pattern play out a lot where there's a huge earnings dip and then, within what? This was within like an hour. The entire dip from 11 to 924 was recovered within an hour, right? We saw it with Snow as well, where this big dip was not necessarily entirely recovered, but recovered about half of it. So I love the bullish entry on a lot of these post-earning trades. That's not what this is, but for upcoming earnings for next week, that could be something to keep an eye on. But we know that right at the money, it's selling for 3.77 ROR. Doesn't mean we have to go right at the money, right? We can go down to like 10.5, sell it for 20 cents, and we'd stick ourselves with the 10.30 break-even price for the upcoming week. That admittedly scares me a little bit. It's something that I like keeping on the watch list because if we zoom out a little bit, go to the 180 day, this thing's been down to $8 a share. It's been down to 9 a share. It hasn't spent a lot of time below 10, but what we know about ChargePoint is it's a former SPAC. And a lot of these former SPACs tend to have price action that bleeds back down below 10 a share. So I don't know if I'm necessarily too excited about getting in here anywhere above 10, but if we get the opportunity to potentially start this thing out with like a half size position on a 10.5 or a 10 where we can get 1%, maybe not the worst idea in the world right there. But just keep an eye on it. Just because something isn't there right this second doesn't mean that it won't be there in an hour, won't be there tomorrow, won't be there next week. Just keep an eye on it, have some ideas, and that's kind of how you're able to quickly act and react in the market. We go back to the scan. I don't know if there's too much here. Unity, we played this one a decent bit, and we played it last week and made some decent cash off of it. Where did it end up? It's back down at 30.87. What I do like is this 30 level on Unity, as you can see by the like insane number of red lines that we've drawn around that 30 level. What I don't like is where it's necessarily sitting from an RSI perspective. It's at 43. It's run back up a bit, but coming off a plus 5% day on Friday, like that's not great entry, right? The great entry is here after it falls back down. This thing is such a volatile stock that it's had its shares of ups and downs. I guarantee you if we just sit tight for 3 or 4 days, we're going to be able to catch this thing on a down day. Hopefully back down near that 30 level where we could sell a strike even lower. But the premium on this thing is so nice sometimes that, look, you can get 2% at 29.5, meaning that you could sell a half-size position, still effectively get more than 1% ROR. And what do I mean by that? I mean that we like to sell 1% ROR per week for our positions. If you sell a half-size position for 2%, that's effectively 1% on a full position. So that's kind of the way that we look at that. And a half-size position is much more flexible, much easier to manage. That's the better way to do it. So you'd want to sell a half-size position here at like 29.5-ish for 63 cents. That your break-even price would be like 28.90. So your break-even price for next week would be like here-ish, which is okay. It's not horrible, but again, one of those situations where we know that if the market comes back down a little bit, this thing is no stranger to falling down very, very hard and very, very quickly with the market. So much better to have this one similar to ChargePoint be one that's kind of sitting in the back of our mind. So if the market does fall back, we could say, okay, some of our positions might be losing a little bit. The market's red, but we know we've got ChargePoint. We know we've got Unity. Yes, it kind of sucks that we might be battling on a couple other positions, but we want to view red in the market not so much as a detriment, but more as an opportunity for us to scale into positions, for us to add new positions and increase that potential max profit number. And if the market never goes down and we don't get the opportunity, boom, we're going to be taking home some cash potentially on the week. So that's kind of the win-win situation we like to set ourselves up with, right? If the market goes up, boom, it's a win. We're going to be making money. If the market goes down, we also want to view it as a win in the sense that, one, the positions we're currently in are going to be fine because we've scaled in appropriately. We've had our initial positions sized properly. And two, it gives us that opportunity to add more, to scale into current positions and add new positions as well on top of that. So this is what we've got. We're going to sit tight. We've got a few names on the watch list. And as mentioned, that I didn't really end up actually talking about, the intersect with feature, right? If we look at something that we want a bullish trade on, we want something that's oversold. So we use intersect, and there's 578 different options right here. How many of those are oversold? And the answer is 2, right? SI and Lumen. So we go to SI, we already know what SI looks like, right? That was at the top of the list. We don't want to touch it. Yes, RSI is at 29.21, but anytime you have a company who has effectively come out and effectively, there are bankruptcy allegations against Silvergate Capital Corporation. This did happen a while ago, a few months ago. And in fact, we sold puts on Silvergate at like the 16 or 17 level. We did that when there were some initial cash concerns with the whole Celsius thing. But what the CEO said was he came out and said, you know what? Yes, Celsius is not a great thing for the crypto market, but we don't have a lot of exposure to them. We have plenty of cash to match our clients' reserves and deposits, which was good. That was good enough for me. I think that made sense. Their financials made sense. And that's typically the response you'll see when a company is not immediately at risk of bankruptcy. However, this past week when the bankruptcy rumors started flying, the CEO did not in fact say that things were going to be okay. I think he had a statement that we're in a little bit of trouble. So that is not inspiring a lot of confidence. Had that not been the case, yes, maybe we try to bottom fish this one a little bit with the spread to keep it safe, but that's just not a smart place for us to be. The other one is Lumen, the March 3 strike put, LUMN. This thing's been sold off a ton. It's down to 22.18 on RSI. And this one is insane how far this thing has fallen. It used to pay a nice little dividend. I think they've slashed their dividend. And it used to be a very stable stock. On a 3-year basis, this thing traded between 8 and 15 on a 3-year basis, but is now down to 317. Admittedly, I don't know a ton about what's going on with this one and why it's fallen down so much. Amid a reset, it looks like. I don't know what this is necessarily talking about. There's new management. There's a new plan. It looks like the earnings haven't been great. But again, at some point, there's kind of a bottom on some of these things. Let's go to the Analyze tab here. Let's go to the fundamentals of LUMN. Let's see if they're making a profit. Let's go down to EPS. Looks like they're losing money. Positive book value per share of $10.42. Now, that's not too bad at all. That definitely far exceeds the current value of those shares. I think that potentially could mean some decent upside. Now, it's tough here. Anytime you've got a stock trading at 317 and you're selling a 3-strike put, 1% ROR is like 3 cents. And at that point, commission does start to become a little bit of a consideration. I would much rather, I don't know what I would want to do here. Maybe if it hits 3, we buy the shares and try to start selling some premium. I mean, this is almost like a better buy and hold opportunity than anything else because I think the upside potential here for it to run back up to 5 far exceeds, if we want to pinch pennies and collect 2 or 3 cents a week on this thing. We could maybe go a month out on it or maybe go out to June or something and sell a 3.5. So where if we buy these shares at 317, this is kind of what this trade would look like. If we buy these shares at 317 and then we sell the 3.5 strike for 30 cents, again, that's 317 on the shares. We're going to collect 32 of premium. We're going to have a 285 basis on the shares with upside to 350. So that's 65 cents of upside on a 285 basis. So if it does get back to 350 or above, that's a 22.8% return in a 3-month period. Pretty solid, absolutely solid. But one, it has to get back up to 3.5. But maybe you're better served just selling these 3-strike puts and just letting that trade ride for 3 months. I don't know. Is there a super low margin requirement for this? No, not even. So probably stay away from this one. Even though it is technically from an RSI perspective, a very, very good entry opportunity. This is where you kind of want to read between the lines a little bit. Evaluate what the premium actually looks like, what the actual trade would look like. And to me, it's just not a super great opportunity here on Lumen. So with that, there aren't a bunch of great bullish opportunities. And again, this oversold stock scan intersects and looks for things below 30. So that we know that when we pull these charts up, we're going to love what we see from that perspective. However, sometimes a stock doesn't always get down to 30 to be oversold. It could be like low to mid 30s. So we want to capture that. So what I did this week was I added another oversold scan, but it scans for things that are below 40. So anything in that like 30 to 40 range that this scan right here might miss, this is going to pick up and it's going to give us some more options, right? It's not exciting when we only have like two options to take a look at here, right? We've got UVIX, UVXY, WHR. I mean, these are volatility stocks. And remember, I think a few weeks ago, we started seeing some volatility tickers on the oversold scan. What happened? The market dropped off. Every time volatility gets significantly like oversold like that, be very, very careful. On the flip side, we could go look at the overbought stocks. Dot, dot, dot. We'll see. Boom. Win. We're already playing that bearishly. OKTA. We're playing that bearishly. Palo Alto Networks. We're playing that bearishly. So if you're wondering like where we get our trade ideas, this is kind of what we do. The philosophy for adding new positions at the beginning of the week. If we had never seen a stock before and it shows up on our profit tracker, this is probably where we're finding it. We took the first three where we can make, between OKTA, PANW, and win. OKTA, PANW, and win. That's a potential $368 of profit. And to find those three trades, all we did was put our scanners in there. We loaded them up. We intersected them with the other scanner we had built. 2 clicks of a mouse, and then we press scan, and you find $300 worth of bearish potential trades to add to that portfolio to balance things out. So with that said, that's what we've got. It's not a very heavy portfolio, but I think with the S&P 500 ETF SPY currently sitting at 52 on a 1-year basis, we don't want to be too far on one side or the other. Once it starts getting past 60 or once it starts getting under 40, okay, I think that's a decent time to start forming some opinions on which side you should be on. But in general, I like to play it a little bit more neutral in that regard. We want to react to the market. We don't want to guess, because when we guess, bad things happen, right? Investing is kind of a series of educated guesses. But when you let the market move one way, use RSI to your advantage, use some of those scans, and pick out some better individual stocks that have nice opportunities, whether it's from that RSI perspective or from an implied volatility perspective, you'll usually fare much better. But that's what we got, right? We took home about $2,700 last week. We're aiming tentatively right now for 1,500-ish. But I have a hunch we're going to have a lot of trades added to that during the week. But that's all we have got for the stream. So back to camera one. Thanks again to those of you who have tuned in at various intervals of the stream tonight. I'm always very impressed if anyone can find like an hour to spend with us on a Sunday night, because I'm sure there are probably better things for you to be doing. So if you're watching live, definitely appreciate you. If you're watching the replay on YouTube, appreciate you just as much. But like we mentioned, we've got a smaller stack headed into the week, but that doesn't mean we can't make money. We could still have like a $1,500-ish base profit. That's still a very respectable number on a 1-week basis. Shout out to Callaway. Thanks for the follow. Jeff, thanks for the message in the YouTube chat. Appreciate you tuning in every single week. But this is how we're going to play it. We're going to sit back, and I think if I had a hunch and had to guess about our activity this week, it might be a little bit more active of a trading week, adding to what we have since we have a small stack of trades as we head into it. So where are you going to see those trades? You're going to see those in our Discord server during the week. If you want to join that, free to join and learn, hourglass-trader.com. There's going to be a big purple button in the middle of it. It says join our Discord server, and that's how you're going to do it. If you want live access to our trades, that's going to be through our HT Premium package, also available on the website. Feel free to ping me on Discord, send me an email, hourglasstrader@gmail.com. Any way you want to contact me, happy to answer any questions you may have. But until next time, this has been Hourglass Trader, where as time passes, we make money. Thanks for tuning in, and hopefully we will talk to you guys same time next week with a little bit more money in our account than we have right this second. So again, can't thank you guys enough, and we will talk again soon.